It was a fantastic day in the stock market here in the United States, with most of our indices up somewhere between 1 and 3%. Not only that, but we had about 90% of components within the market close in the green here today. So it was a runaway rally here for most sectors across the board. We also saw some important technical indications where we were able to clear up and over some important resistance areas, not just moving averages, but also important prior horizontal resistance areas. So we'll talk about that in tonight's video as well. Now, before it sounds too enthusiastic, I must let you know that things are not looking so hot in the after-hours session, with Alphabet and Microsoft leading the way lower. So all this enthusiasm that ended today's normal session might be given away to a whole bunch of selling first thing tomorrow morning. So we'll see what the implications of that are. And then in our trade application example here tonight, I wanted to focus on an international country that's starting to perk up to my eyes, and I wanted to conduct what's known as an iron condor trade on that particular entity. So with that, let's go ahead and get started. Welcome to the Market Outlook video presented by MarketScholars.com. I'm your host, Brandon Van Zee. It's October 25th, 2022. First of all, if you're new, welcome aboard. Remember to go over to YouTube, click subscribe on our channel, then go down below into the description area. Make sure you're signed up for our email distribution list so that way you can be notified whenever we post these videos. At the bottom of those emails, you'll also find which stocks in the S&P 500 are giving you overbought or oversold cluster signals. In addition to that, we're heavy users of Twitter. If you're not doing so already, I would encourage you to follow me at Brandon Van Zee. We really appreciate those of you that click like and retweet on these Market Outlook related posts. And then last but not least, we do have a presence on Facebook. Feel free to join our group at that web address you see in the logo in front of you. All right, let's go ahead and jump into today's trade activity, starting with our S&P 500 heat map. And as you can see, it was a glorious day for the bulls. Now, before we get too excited about that, I will just let you know that there is a cold, wet blanket being thrown on top of this image in the after-hours session, as we have a number of stocks that are important stocks to the market with large market caps that have disappointed Wall Street thus far. We shall see if it ends up turning around tomorrow morning or not, but right now we do have a little bit of a whimper after hours after such a robust bullish day here during the normal session. So let's talk through the normal session first, then we'll kind of get into some of the after hours movement there. Starting with Tesla. Obviously, Tesla, one of the most influential companies in the S&P 500 these days because of its market cap of $700 billion. It was up 5% here today, so a great day there for Tesla. Pretty strong day there for Apple, up nearly 2%. Microsoft up over 1%. We saw Nvidia up 5%. We saw Alphabet up nearly 2%. Meta up 6%. Visa was up about 2% there. So those are some of your heavy hitters from a market cap perspective in the tech world. You also saw some of these software companies up here doing well. By the way, good news there on the Adobe front. Those of you that are premium members of Market Scholars should have seen my tweet, or not my tweet, but my Telegram go through here recently on our private Telegram channel, that we were able to successfully close down that bullish swing trade that I took in this presentation last week on Adobe at max gain, and that was a really nice one because of its price. Some of you may have noticed that I usually just use the default trades when it comes to setting up the trades for these Market Outlook videos, which is a little bit different than how I do my trading rooms. So we had 100 shares of Adobe, and as it was a $300 stock, that was actually a pretty big outlay there. So I'm thankful for that one came through in the clutch for us with a nice profit win, made over $1,000 on that one. We also saw that Amazon was up 0.65%. Berkshire Hathaway was up 0.6%. And then, you see some of those, bigger consumer staples and even some of the bigger banks doing reasonably well here today as well. So all in all, pretty solid day across the board. In terms of who our letdowns were here today, We did see that Johnson & Johnson was down just a touch, and they are the largest, or at least one of the largest, probably neck and neck. Yeah, it looks like United Healthcare has got them just by a skosh in terms of market cap. United Healthcare over $500 billion these days. Johnson & Johnson at $450 billion. Both of those were down today. We also saw Amgen and AbbVie and Abbott Labs down. CVS was actually one of the worst performers in the S&P 500 today. It was down 2.7%. And so it was a little bit of a letdown there, it seems, in the health space. Should mention as well that Coca-Cola had a very nice earnings report earlier this morning. They were up 2.4%, a good dividend king there, as a stock that's raised its dividends for more than 50 years in a row. In terms of other areas that were a little bit of a letdown today, I'd probably throw energy into that conversation. You can see here that it was a little bit of a mixed bag. Chevron was up as an example, but Exxon and Conoco and EOG and Pioneer, they were all down. So that one seemed to kind of stand outside of the rally in general with the market today. And then we had a little patch of red up here in the upper right-hand corner. This is where we house the financials. And there's a specific industry within financials that seemed to take it on the chin today, and that was insurance. And it might have been as a result of this one right here. Not a particularly important company usually. This is actually a dividend aristocrat, not one that you'll hear me talk about much because its dividend yield is extremely small. Remember, you can have stocks with very small dividend yields even if they've grown that dividend for 25 years in a row. It just depends on what happens with the stock's price to determine what the yield will be. But anyway, Brown & Brown, one of the most recent additions to the dividend aristocrat list, was actually the worst performer in the whole stock market today, at least in the S&P 500. It was down over 12%. So I have a feeling a lot of these other insurance names kind of were down in sympathy with that big sell-off there in Brown & Brown. So, all in all, I would say this was a really solid day for the bulls. And we'll talk about the chart here a little bit later as well, where I'll have some pretty good analysis or pretty strong supporting evidence that we had a good rally here today. But again, I think it behooves all of us to act cautiously around this market in 2022 because so far in the first 10 months of the year, you've usually learned to regret it if you haven't been cautious, because more times than not, anytime you get excited on the bullish side of the equation, it seems like the bears are just around the corner, waiting with a big sell-off on the horizon. So we'll see if that happens again this time as we kind of approach the more bullish seasonal time of the year for the market. But it has been obviously a very challenging year if you've been on the long side of the market. So I always want to make sure that I don't get too excited about days like today, even though credit where credit is due. There were some very good signs in the market here today for the bulls. Let's go ahead and have a little chat here now about the after hours activity. So sorry to spoil the party so soon, but after looking at all that really awesome price action to the upside here in the normal session, unfortunately, the after hours is quite the letdown. So let's come on over here to the trade tab, and we'll rattle off some of the bigger companies that were reporting earnings after hours, starting with the second largest publicly traded company in the United States, which is Microsoft, second only to Apple, which will report, I believe, on Thursday. So this is a huge, huge week for earnings. So buckle up. It's going to be interesting to say the least. You can see here Microsoft struggling in the after-hours session, unfortunately. Great company, just a question of whether they've gotten ahead of themselves in recent years like so many tech stocks have, as the NASDAQ has just gone blistering hot to the upside up until 2022. So I don't think there's necessarily anything wrong with Microsoft, the company. It's just that the stock itself is probably priced to perfection and is getting hit pretty hard after hours as a result. So the stock is down about 6% here as we speak, at least according to this headline that I see. And you can see that it closed at 250 in the normal session, but currently in the after-hours session, it's down nearly $20 per share. Not quite, maybe about 17, but nonetheless, it's a big haircut that it's taking after hours. Microsoft at this point appears like it's going to be opening up closer to $233 after having such a beautiful day here today. So it's going to give back all of today's gains and then some as we open up tomorrow morning, unless there's some sort of miraculous turnaround. Remember, that does happen occasionally. Sometimes, the company announces their results and investors immediately sell, and then the executives of the company get onto the conference call and start talking about future orders and their expectations and things like that. Or perhaps the Wall Street analysts will upgrade it in the morning, right? So there's always that possibility. In this case, I would be surprised if that happened, because this is such a liquid security. It's not like you're turning over too many stones or rocks to find Microsoft. It's right there in plain sight. So it's going to be one of those companies that has an immense amount of analysts, and since this is a $1 trillion plus company, the chances of the market collectively being wrong by 6% after hours is probably less likely than what could be the case for smaller companies, where sometimes that type of stuff does happen. But we shall see. Right now, not looking so hot for Microsoft. As we mosey along, let's talk about one of the other biggest 10 companies in the United States, and this is Alphabet. And I wish I had better news for you here as well, because unfortunately, it's another knock to the side of the head here, so to speak, as Alphabet is also suffering after hours. They were up at 104.48 upon the close, and I am using the Class A shares here. Remember, you can also pull up the Class C shares with GOOG, but in this case, just looking at the Class A shares with GOOGL, and it closed at 104.48 to end today's very robust and bullish market session, only to suffer the same way that Microsoft is after hours. You can see that it is now trading down there at $97 after hours. And remember, Google has been, a prominent growth stock for many, many years at this point. In fact, I still remember the day that it went public, probably back in, I don't even remember, maybe 2005, somewhere in that time period. But it's been an extraordinary success and well-deserved. I mean, they basically own the advertising market online. And, they also own other things like YouTube, obviously what David and I post our videos to here. So we're certainly familiar with some of their offerings as well. And they're a fantastic business. But again, sometimes things get a little ahead of themselves. And as we start examining whether we are approaching an actual economic recession or not, some people say we're already in it. Others say, there's still some debate there. But either way, if we are either in it or heading towards one, there's a pretty good chance that advertising will be pulled back. Remember, that's a little bit more of a discretionary spend for a lot of businesses. If it's between keeping your last two employees on the payroll or doing a little bit more advertising next month on Google, you probably know what decision most employers are going to make. So, this could be just some nerves with the market in general that advertising will suffer moving forward if we are heading into an economic recession. It's really not that expensive. Microsoft is more expensive. Both of these are cloud plays to a degree. Google's only trading at 19 times earnings, so it's not particularly expensive in my eyes, but they did miss, just to be fair. I don't know what the exact number was. Here it shows that they beat. Maybe it was the revenue number that I heard. I had business television turned on here this afternoon, and I wasn't paying full attention. I was just kind of catching some bits and pieces here and there. But I thought I heard that Alphabet missed, but maybe it was on the revenue number. Here it shows, at least on Thinkorswim, that they came in with $1.40 of profits, and the estimates were $1.25. So here it kind of looks like they beat, but maybe there's other ways of evaluating that. Regardless, the outcome is official, which is this stock is trading down heavily after hours, down about 5 or 6%, somewhat similar to what we're seeing there with Microsoft. Let's continue with the hit parade, and not a good hit, a hit across the side of the head. How about Texas Instruments? Texas Instruments, a very noteworthy dividend growth stock, I shall add, in the semiconductor space, and a company that's grown its dividends for, probably 15 to 20 years, somewhere in that general vicinity. They've done really well, over the time, kind of growing out their various lines of business. Of course, a lot of people think of the calculators on their desk when they think of Texas Instruments, but the calculator business is basically an afterthought to them. This is one of the world's biggest semiconductor companies. And semiconductors, obviously, were all the rage for many years, but we've seen a violent reversal here in 2022. Part of it as a result of a little bit more tension between the United States and China, how that all shakes out with the relationship with Taiwan as well, and maybe a little bit more onshoring here in the United States with the semiconductor industry, which will come at a cost, and therefore profits and margins and things like that could be squeezed going forward. So Texas Instruments, just like Microsoft and Alphabet, down significantly after hours. They closed at 162.16, and they are currently trading about $9 per share lower, around 153. But at some point, this one could get somewhat interesting. They are yielding over 3% these days. Then again, the 10-year Treasury yield is over 4% these days. So I guess if Texas Instruments ever yields around the 10-year Treasury again, it could be an interesting choice for those looking towards the future as a long-term investment. Let's see what else is reporting here today. Chipotle. Not a company that pays a dividend, but kind of in that same vein of some of these stocks we've already talked about, which is the market kind of perceives them as being a little bit more growth-oriented, like we saw with Google. I also remember when Chipotle went public. Once upon a time, remember, Chipotle was owned by McDonald's. My son is a big fan of Chipotle, and he was shocked when I told him that. But it is true. Back in the old days, McDonald's owned Chipotle. And I bet they wish they could get it back, because Chipotle has been just a huge, huge success over the years, becoming one of the most important fast casual restaurants here in the United States, and probably will start expanding globally a little bit more actively as time goes along as well. But let's see how they did here with their earnings tonight. You can see that they closed today's session up 2.5% at $1,584. Remember, this is a high-price stock. I don't think they've ever done a split since they have gone public. So, one of those companies that kind of defies a lot of people, especially those that are not fans of Chipotle. I happen to be a fan of Chipotle, so I think they're worth every last dollar of that $15.84 there. But there are a lot of people that question that, like, how is this burrito company worth $1,500 a share? And of course, the real answer is because it's never split its stock. The price per share is effectively meaningless. What's more important is the market cap. But that's neither here nor there. What's happening after hours is that they are struggling. Not nearly on a percentage basis as bad as what we saw with Alphabet and Microsoft, but nonetheless, maybe a little bit disappointing there, particularly given the context of the situation. Because as soon as they reported their earnings, Chipotle's stock did rise in the after-hours session. You can see that it hit a high of $1,660. So it was up, about $80 per share after hours. And unfortunately, they've given all of that back and then some. And currently, you can buy them for just under $1,570. So down about $14 per share after hours. And then let's pop our head in on one last major company, and that would be Visa. And here, finally, we've got a little bit more enthusiasm. It's not going to be enough to block the what appears to be the crack in the dam that's probably going to hit the market tomorrow because of how important Microsoft and Alphabet are. Nonetheless, at least Visa is up after hours, and like some of you just saw me tweet about here maybe an hour or so ago, the other good news with Visa is they raised their dividend by 20%. In fact, I see the headline right there. So unfortunately, similar to my comments on Brown & Brown here a little earlier, Visa is a company that has almost always had a very small yield, even though they have an extremely fast dividend growth rate. So anyway, they closed the session at 194.38. It's currently trading around 196. So up a couple of bucks after hours. But again, that's it's nice to see, don't get me wrong. It's just not going to offset the damage that's going to be done by the mega cap tech-oriented companies that are out there. In fact, one thing that is of note is many of these companies are part of the NASDAQ. And if you pull up the Qs after hours, you can see it's not looking so hot. The Qs ended today at 284.21 in the normal session. And that was up 2%. And remember, the Qs had been lagging. The NASDAQ had been lagging the Dow and some of these other major indices. And so it was really nice to see the NASDAQ finally come alive today. And wouldn't you know, as soon as they do, they put the kibosh on that. And the stock, or this ETF, is trading down significantly after hours. It's down below 279 as we speak. And it opened today at 279. So effectively, the after-hours activity on the NASDAQ is washing away all of the bullishness from the regular session today. And that doesn't bode well for the S&P 500 either, because remember, the S&P 500 is also a market cap weighted index. And while it does have a bit more diversification than the NASDAQ, because it's going to include more utilities and things like that, still, it's going to be your big time companies like Microsoft and Alphabet that dictate the fortunes of the S&P 500 itself. So, brace yourself. Pretty decent chance that tomorrow morning we're going to end up having a little bit of selling pressure on Wall Street after a nice 3-day rally. Here's SPY after hours, by the way, in case you're curious. It closed basically up there at 385. In the normal session, it's trading closer to 381 right now. So it's not a massive meltdown right now, but it is definitely a disappointment after having what appeared to be such a strong 3-day rally to kind of cap things off with these disappointing earnings. Will get some folks second guessing their positions as soon as tomorrow. All right, let's go ahead and take a look at some of our market breadth statistics today. And again, this does not include any after-hours activity, so this is only as of the normal session's close, but there were some pretty promising numbers out there. 448 companies in the S&P 500 closed higher today, so that was good for about a 90% hit rate there. So 90% stocks up, only 10% of stocks down in today's session. That's what you want to see traditionally if you're bullish. Now, obviously, that's not the only thing that affects stocks, as we are seeing in the after-hours session with earnings and other news here tonight. But just from a purely organic perspective, you do want to see mass participation on the up days, and we did experience that here today. Let's go ahead and take a look at some charts now. And as is typically the case whenever we have a move of more than 1% either up or down, I like to start with this chart 6D. Remember, if you're a premium market scholar, you have access to all 50 plus customized charts that David and I use. If you're not a member of Market Scholars yet, then mark your calendars for about a month from right now. Next month will be Black Friday, and we don't do too many sales throughout the year like a lot of other firms. We're too busy doing a lot of other things like teaching classes every single day. So we are somewhat limited on the amount of sales that we do here at Market Scholars, but one that we've tried to do every year that we've had this business, which is the last 5 years, is to do a Black Friday sale. And we typically do 20% off our 3-year premium subscription. And so if you got a few dollars saved up and you're looking to advance your investor education and you want to tap into David and I's trading rooms, remember we each teach 5 premium classes per week. So that's a total of 10, with 8 of those 10 being trading rooms where we're actually managing portfolios based off of different strategies. And then the 2 additional classes are question and answer sessions where you can work directly with David and I and have us answer your questions that you might have out there and pick our brains along the way. So the other thing I should mention about that is if you are still in your working career, all of our classes are recorded. In fact, if you signed up for our premium service, you could theoretically go back 5 years ago and watch our very first classes if you want. They're all available to you once you're part of our program. So that's the nice thing as well. So that way you don't have to feel like you're missing out if you can't attend live. Anyway, anyway, we'll save the rest of that for later. As you know, David and I do not twist arms too aggressively when it comes to our business. We figure if you like what you hear out of us and you like what you see out of us, then it sells itself. And if you don't like what you hear out of us, then that's fine as well. We're not going to be the hard sales type, but definitely want to let you know that it's available to you at the same time. All right, so let's get into chart 6D here. And as you can see, this was our third straight day of upside activity. And not only that, this was our third straight 1% up move as well. In fact, it started with a 2% up move with this candle. And then we had another 1% move here yesterday, and then, another 1% plus move here today. So that's somewhat rare. Now, as I looked back, it had happened earlier in the year as well. And if I can eyeball it here for you, I'll show you where that was. It did happen back here at the end of July as well. I guess it would have been this candle, and this candle. Those three were all 1% plus types of moves as well. And you can see we did have another maybe week or two of upside activity after that 3-day move before ultimately rolling over and then cutting into, of course, new lows once again. So, that's maybe somewhat promising to know that, hey, it doesn't have to end right here. We see direct evidence of how we were able to get a little bit more mojo out of the market back then. And then I believe there was another time back here. Yes, right here. We also had a 3-day 1% plus rally. In fact, two of those were 2% days, right? Back-to-back 2% days, and then followed by that third day as a 1%er. And that would have been during these candles that you see right up above here, basically in the middle of March. And again, there you had a bit more juice, a little bit more of an adrenaline push to the upside for the next week before rolling over and undercutting those lows. So, I guess that's the good news here is despite what we're seeing in the after-hours session right now, history has suggested that at least it's possible for us to keep on moving higher before ultimately failing. But we shall see. In one way, it will be nice to see how the market handles tomorrow, because it will be a test. If the folks that are out there calling for this to be the start of a new bull market right now are going to be correct, then this market should start to act more like Teflon, where bad news does not affect it. Tomorrow, we're most certainly going to get that bad news, and we're going to start out in the hole. But if the market participants can kind of rally the market back during the normal session tomorrow, that'll actually be a pretty good sign for the market in general. So in a way, while we don't like to see all this selling after hours here tonight, it will provide a good litmus test for whether the bulls are truly in this to turn it around, or whether they will end up disappointing us once again like they've done so many times in 2022. The other thing that I would point out is that you will notice here that the VIX remains pretty high. It did sell off today, just like the VIX typically does when the market is up. But note that the VIX is still basically hanging out right around 30. It's just a touch below 30 right now at 29.65. So that's pretty high considering we've just had 3 1% plus up days in a row. And it's basically telling us that not everybody in the market is convinced that this is the bottom, right? And I'm pretty sure you've never heard David or I say that either. It could be, I think we're open-minded enough and flexible enough to say, yeah, it's possible, but is that the likely outcome is what is more of an interesting question. And from that perspective, I'm still not particularly convinced, but I remain flexible, and if we start to see more constructive activity on the charts, I'm more than happy to change my mindset around. But I do think that we have a lot of potential landmines out there that we have to navigate with, of course, the Fed. One of the interesting things about this 3-day rally is we haven't heard from the Fed. And remember, the Fed has been our enemy, in the stock market for quite some time. It seems like previously, whenever we've had a pretty good little push from the bullish side of the equation, we'd hear the Fed and the Fed governors come out, and it feels like every, a couple times a day or something like that, we hear from the Fed, and they're talking down the market, talking tough, talking about how they're going to keep on raising interest rates and squash inflation and all this stuff. And of course, the markets get concerned about that and start selling off. But the Fed apparently is in one of their quiet periods right now, just because of the timing before their next interest rate decision. And so we've had kind of free reign here for the last 3 days to have the bullish animal spirits alive and well without the threat of one of the Fed governors coming out and saying, oh, we're planning on raising interest rates another 100 basis points early next year, and stopping the rally in its tracks. So I think that kind of plays a role in where we're at right now as well. Remember, don't fight the Fed, don't fight the trend. And right now, the Fed remains more on the hawkish side of the equation, not dovish, and the trend of the market, to my eye, still looks largely lower. While at any point a reversal could take place, we haven't seen enough of it off of the bottom yet for me to actually claim that we are back into a bullish trend quite yet. Let's go over here to our normal 4-grid charts now. This will be chart 4B. And as we get this pulled up here, I wanted to point out that we had a really nice day on the market, pretty much across the board, which is why this after hours activity is such a shame, because this is the type of behavior I want to see, which is, you guys heard me talk about the last time I was with you on Thursday, that I remain cautious and hesitant towards this market because it's taught us to be, cautious and hesitant all year long. But if I am to change my mind, what I need to see happen is for us to get through the 30-day moving average and for us to stay above the 30-day moving average. And there I actually have some pretty good news, because we went up to the moving average here, I guess it would have been Friday. We cut through it yesterday, and we continue to sail through it today on the S&P 500. That's what I want to see, right? That is very bullish behavior there. And not only that, but we were able to get up and through this resistance area here from the first week of October as well. In fact, the month of October is proving to be a very bullish one, especially for the Dow Jones. We'll talk about that here in just a moment. But I just wanted to point that out. And let me right-click and maximize this so you guys can see this a little bit better. Notice this 3-candle formation right here. It did not hesitate at that moving average. Remember, that's test number 1. I was talking about, in recent weeks how we had that test back here and we failed spectacularly. We had that awesome 4-day rally, went up, touched that downtrending 30-day moving average, and the next day the market just puked it all up. Here we've had a 3-day rally, not a 4-day rally, but it's actually much more constructive, because here when we tested it on the first big push on Friday, we didn't use that as an excuse to sell off and roll over. Instead, we continued that bullishness up and through that resistance period from the first week of October. So I do like this activity here. Again, I think it's got work to do because we need to now see it stay above the moving average. And I think it's got a pretty decent chance to do that, considering we've got a lot of separation right now between where it's trading and where its moving average is. But I also fear that the Fed could come out and spoil the party at some point, and just want to remain more vigilant in a year like 2022. And so I think I need a little bit of extra convincing, I guess, in this particular case. Again, I will say that, hey, we're approaching a more bullish time of the year. For those of you that are Stock Traders Almanac fans, as I am, I have a copy sitting at my desk here, as I have for many of the last probably had the last decade plus I've had it sitting on my desk. So kind of enjoy reading through the different statistics and stuff and understanding that nothing is perfect, but it can help you shape your mindset and things like that. And one of the things that they have popularized over the years is this concept of the best 3 months. And for the stock market, the best consecutive 3-month period is November, December, January, traditionally, if you were to look back throughout the years. And we also have been hearing all these statistics on Twitter and elsewhere recently about how usually the stock market is quite bullish in the 6 months to a year after the midterm elections, where there is an extremely high hit rate in terms of bullishness after that as well. So there are some elements out there that do favor like a strong move. And, the other thing I would point out is this was a really important candle back here. I think I was with you that day. As you know, I do the video on Tuesday, Thursday. David does it the other days. And I remember talking about this candle and its importance because it had engulfed 3 of the previous candles there, and that is something you don't see a whole lot on a big index like the S&P 500, especially when the prior candles were these oversold cluster signals. And remember, these little green dots that are showing up on the chart here are as a result of the green line, the blue line, and the red line all in the lower reversal zone on the same day. And in the past, especially in a year like 2021, heck, it was rare to find just one cluster because the markets were so bullish to the upside. We just went through a period where we were seeing clusters day after day after day. In fact, we had 5 days in a row of clusters here. That is insane and something that is not normal at all. So are we surprised we're getting a snapback rally? No, that probably should have happened earlier. If anything, the surprise was that it didn't carry forward after this 2-day rally here. But we're getting a little bit more push right now. But this should not come as a surprise that we're getting this reversion after this extreme oversold conditions over here. But it's just a matter of how far it can take us and whether it's got the actual power to turn a bearish market into a true bullish market moving forward. And, there's always going to be a debate there because nobody has a crystal ball. Technical analysis is not perfect. But I did like that candle right there where we had that big engulfing right after the oversold clusters. And that has seemingly been a launching pad of sorts for this market. And I also like how the market did not stall out at the moving average. It continued to carry forward. We took out a mini resistance point already. So there's some bullish elements in the air without a doubt. It's just that we've learned to tread a little bit more cautiously in a year like this. And so we'd like to see a bit more time spent above that moving average if at all possible. Right now, the S&P 500 was up 1.63% today, and the green line is at 43 and rising, so we would consider that weekly bullish. Let's talk about the Dow now, because this has been the true leader, right? I've been talking about this in this presentation here for the last week or two, and it's been rather impressive, I must say, because usually you don't see it shake out this way. Usually the Dow is kind of like the old school blue chip bellwethers that, they might not go up as much as the rest of the market in the bullish years, but they typically don't go down as much as the market in the bearish years. Well, this was kind of a surprising move out of the Dow here, and I think it was really kicked off by JP Morgan, quite frankly, because remember, the banks usually start things off when it comes to earnings season. And I think it was kind of JP Morgan and company that allowed this thing to really take off. And it is the leader of this market. I've been kind of pointing out this intermediate reading to you guys here and comparing the Dow to these other 3 to express my opinion of that. But now I can express that in an even more obvious way. Take a look at the color background of the Dow, which is dark green. Notice the colors of all 3 other charts are light green. Also, notice that after today, we now have a green 30-day moving average. None of the other charts can say that. And a reminder of what that means is that price is now above a rising 30-day moving average for the Dow. The other charts, prices are above the moving averages, but the moving averages are still falling. So there's a little bit more conflict on those. So in my eyes, it's not even really a conversation. The Dow Jones is the leader right now. And whether that's actually good or not is debatable. I don't mind it because I'm more of a long-term dividend guy. So I kind of like seeing those blue chips outperform personally. But that's neither here nor there. What it means for the market collectively is usually not as promising. And typically you want to see a little bit more robust activity out of the more speculative areas of the market. You'd prefer to see the Dow lagging. In this moment, it just happens to be leading. So we'll see how long they can keep that up. But I really do like the activity of the Dow. At this point, the Dow has been above its moving average for the last week. Now, today was the first time the moving average was up, but for the last week, it stayed above that moving average. Remember, it was the first index to cut above it, and I was impressed, and I've been saying as much here in these videos, which is why these things catch our eye. We want to share this information with you, and you heard me say in the last couple times I did the video that, you know, the Dow has been impressive to me because of its resilience above that moving average, and that continues to be the case. I still have no qualms with the Dow. It is acting the way you want to see it act. And look at how much further above this resistance point from early October the Dow is. The S&P 500 basically just cleared that resistance here in the last 24 hours. The Dow did that way back here, you know, about a week ago, and has held those levels and stayed above them, right? That's important too, because sometimes you get those breakout retest types of situations where the retest fails and you see the previous trend hold. In this case, you had the breakout. You retested it a little bit with these 2 days, but you stayed largely above much of the candles over here, and now the last 3 days you've cleared well above that. So the Dow has been really impressive here, and I'm sure they'll probably get hit tomorrow as well. Remember, Alphabet's not in the Dow, fortunately, but Microsoft is. So there will be a little bit of a hit to the Dow tomorrow as well, so we'll see how it looks after that. But right now, knowing what we have in front of us, you know, this is a pretty nice looking chart where there's a legitimate attempt at a reversal taking place right before our eyes there on the Dow. It was up another 1.07% today. We talked a little bit about the NASDAQ earlier, being one of today's leaders. I guess technically the Russell 2000 was up 2.7% today, which was a big move for it. But the NASDAQ wasn't too far behind, up 2.25%. And the NASDAQ had some nice bullish activity as well, where it broke above its moving average today. But the problem with the NASDAQ is you can see that it's now sitting right at this resistance area from back here on the first week of October. And what we know at this point in real time is that there is an extremely high likelihood that the NASDAQ is in sell-off mode tomorrow. In other words, it's not going to break through this resistance point. The high back there on this candle that I'm pointing at on the old National Truck Drivers Day, 10-4, Big Daddy. That's the October 4th date there, 10-4. We've got the high being 11,189, and we just barely cleared that here today by only 10 points. But as soon as tomorrow, we're going to be back below that high. So that could be an example of a breakout attempt that ends up failing. And the way things look right now, there's a decent chance that the NASDAQ could actually get back below its falling 30-day moving average, right? So that's why we like these charts like the Dow so much, because you can afford to have a sell-off day or two and not threaten the overall trend, because you have so much separation between the moving average and the candle. But with the NASDAQ, you've got hardly any wiggle room. And as soon as tomorrow, you could easily see the NASDAQ trading below its falling moving average again. And if that happens, its moving average will change back to that red color, just like it's been for much of this fall. So I wish I had better news for you on the NASDAQ, but not looking so hot tomorrow morning. We'll see. And remember, because earnings season is so dynamic, we actually have a lot of companies reporting earnings this week, including Apple and Amazon and Meta and, you know, tons of other companies that will be reporting later on. So maybe it's just a situation where, hey, we got a bit ahead of ourselves here on Tuesday night, but maybe the rest of the earnings will come in swimmingly. So we can't forget that is a possibility there as well. But for right now, unfortunately, it's looking a little sour there for that tech-heavy NASDAQ. And then the Russell 2000, impressive 2.7% day here today for it, just like the S&P 500, the NASDAQ Composite, now the Russell 2000. They all have weekly bullish postures. Dow is the only one with a strongly bullish posture. But similar to the other formations, a good day there for the Russell 2000, where we did close basically at the high of the day. Another thing that stands out to my eye is notice that it is the only one with the daily range label orange in this case. All of the other ones are blue, meaning that the Russell 2000 actually had an above average range day today, and it was bullish, right? And that's a good thing. It is fairly common to see the big up days with less daily range than their average true range. And then typically on the big down days, it's kind of the opposite, where you do see a lot more extreme movement in the sell-off days. So that's a more promising sign there for the Russell 2000 as well. You had a big range day today, and it was a big bullish day, and you closed basically near the top of the candle here today. And in doing so, you cleared above kind of a double top. This one's hard to see because of the doji effect that it produced when it was all said and done, but you had this day here on October 18th where we came up to, I don't know, about 1780 or thereabouts on the Russell 2000, and then you had approximately that same level at the high back here on October 4th as well. So it kind of formed a little bit of a double top. It's not a huge deal there, but nonetheless, today's candle did prove that it was able to get through both of those candles and clear them by closing above them. And that's an important aspect there as well. So, again, I don't want to, throw a big wet blanket on this whole party. This was some pretty bullish activity that we saw today. This is what we want to see when bottoms are being formed. It's just a matter of whether this is the moment in time where the market, can kind of garner up that strength. And in order to do so, it's going to need help from the mega cap companies. And that's where we have the disappointing news after hours here tonight. Let's step aside here real quick, pop on over to the internet. I always like to get a chance to say thank you to those of you that help support this free market outlook video that you'll find on YouTube. The social media company that I hang out at the most is Twitter, but we certainly appreciate those of you that click like and thumbs up and all that good stuff on the other social media things as well, like LinkedIn and StockTwits and Facebook and even on YouTube itself. But usually what I use as my gauge as to whether we are being effective for you here with this free video or not, a very simple thing, because many of you are already on Twitter, as many of you know David and I from Twitter, is just to click like for us there. And so, as I always say, as long as we're up and over 100 likes, I'm happy to give you a full-length video the next time I'm scheduled to do the video, which is why I'm doing that for you right now, because you were way up past 100 likes for me when I did the video last on Thursday. So thank you very much for that. It's heartwarming, to say the least, to know that these videos mean so much to you guys. So let's do some shout outs here. Thank you to Brandon Walker. Thank you to Carl Norton. Thank you to Ron Pearson and Roger Holder and Michael Howe and Barry Scott and Michelle Addy. There's Matt, there's Stock Market Junkie, there's Paul Gerard, we've got Doug, we've got Arth, we've got Ali, we've got Sarah, Sonia, we've got Irene and John, David and Ayakipa and Paul and Roger and Phil and Greg and Steve and Kirk and Gerald and Pam and Vodacon and Austin and Rick and Michael, and the list goes on and on and on and on. I can't get to all of you, but I do like to at least acknowledge you when I get that opportunity. So thank you very much for taking the 5 seconds out of your day to click like for us, as these videos do take up a considerable part of our afternoons. And of course, we're not really making any money off of doing these videos, but we do hope that they are effective tools educationally, and the way that you guys can say thank you to us if you want us to continue them as often as we do is just simply click like for us. Remember, the easiest way is just go over to Twitter and you'll find our most recent market outlook video posted or pinned to the top of our Twitter timeline. Otherwise, there's 3 other ways to find that tweet in question. If you're watching this directly on YouTube, you can go into the description area and you'll find the Twitter link there to the tweet that we'd like you to click like on. We also allow you to click like on the little Twitter widget if you're watching the video directly on our website at marketscholars.com. And then last but not least, those of you that are on our email distribution list, you'll find that in the emails that we send you during the nights, that there's a little Twitter icon near the bottom of the email that you can click on as well. So whatever one of those 4 ways you choose, they all kind of end up in the same count there. So we do really appreciate that. It's an easier way for David and I to get the word out about our fledgling company here, much easier than we can do on our own, right? For all of you, you're kind of our built-in advertising, I guess you could say, sending this information out to your own social networks, which is a lot further reach than what David and I would do as just two individuals there. So thank you very much for helping support us. That it goes a long way. Please keep it up. Let's go ahead and also take a look here at our sector selector. So our sector selector, a reminder, it gets produced on Friday evenings. So this is not including any information for the first 2 days of trading thus far. And a lot of times that's not that big of a deal, but I would say it's probably a bigger deal this time around because the first 2 days of this week have been pretty big performance days. And so it does have an ability to kind of impact these numbers a little bit. But it can still give us a pretty basic idea of what's been happening sector-wise out there. Energy continues to lead. Stop me if you've heard me say that before, right? This is the 4th week in a row that's been the case. And even beyond this is a rolling 3-week graphic here. But prior to July, in this case, for the first half of 2022, energy basically lived at the top. Remember, we had that one stretch where energy was literally the #1 position for all 13 weeks that you see here. And that has hardly ever, if ever, happened before with one sector dominating the way that it did. So energy has been the clear winner of 2022. But we've had a few sectors kind of sneak in and out along the way as well and kind of get their time in the sun. Right now we are seeing a little bit more of a push into industrials. I saw that UPS had their earnings announcement here today. Healthcare has been doing a little bit better here recently. And even financials. I mentioned JP Morgan earlier. Goldman Sachs and some of those other bigger banks have come through pretty nicely with their earnings reports thus far. On the flip side of the equation, no surprise that utilities and REITs are 10th and 11th here. Remember, those are the two that are most interest rate sensitive. And so when interest rates go up, those are the two that you should expect will do the most poorly on a relative basis, all else being equal. And so that's kind of the environment that we find ourselves in right now, where we have more robust stock market activity, where we've got a little bit more of a risk-on mindset, and therefore the defensive characteristics of those two aren't really valued at this moment, in addition to them struggling with their interest rate sensitivity. So we'll see if they stay there. Obviously, if the market goes into a bear market here moving forward, then there's always the possibility the utilities could make their way back higher again, despite their interest rate sensitivity. But for right now, they're kind of hanging out there down near the bottom. Now remember, if you're a long-term investor, that's not necessarily the end of the world. This graphic is for my trading class. This is for my top-down trend trading class on Monday mornings. But as I always tell my dividend growth investors in Tuesday mornings class, like this morning, we evaluated REITs. We actually talked about 2 REITs in a head-to-head matchup that we really hadn't had much of a history with. We're currently in the midst of our 10th portfolio construction here at Market Scholars for the DGI class. My oh my, where has the time gone? But anyway, our head-to-head matchup of the 2 REITs today, one of them we had never talked about before, and the other one we had only talked about one other time in a class back in 2019. So remember, with these big market sell-offs that we've had more new merchandise to sink our teeth into, as opposed to the same old when stocks are just gradually grinding higher. And most of you understand the reason behind that. Of course, dividend stocks are somewhat unique, where you want to buy them when they're down and out because their dividend yield is more favorable. Now, that only works if you trust that the dividend won't be cut. So you have to be careful with that endeavor as well. And that's what we strive to do in my dividend growth investing classes each and every Tuesday morning. So if you're a premium member, feel free to check out the recording. It's already up here in the trading rooms area, and check out which 2 REITs we compared to one another today. And we did add one of them to our class portfolio. Also, real quick, over the weekend, I did post the Ask the Assistants forum here under the community tab. It was always under the community tab, but it was kind of hidden in some of these other groups and areas like that. This I just basically brought to the forefront to make it a sub-menu. The Ask the Assistants forum, for those of you that aren't familiar with it, is for our premium members. If they don't want to ask David and I a question, which of course we would love to have their questions, and we tackle their questions every week in the Q&A classes, but sometimes people feel more comfortable asking questions of their peers instead. So we have a couple of assistants here that are technically our students or clients, but they're willing and able to help answer questions because they've been with us for quite a long time. So just FYI, for those of you that are premium members, if you were ever looking for the Ask the Assistants forum before and you found it hard to discover on our website, now I've made it a little bit easier for you, put it directly underneath that community tab. All right, let's get back on track over here on the Thinkorswim platform with some additional charting analysis. And let's get started here with the asset class 12 grid. This is chart 5A for those of you following along at home. Now, as you know, because we've talked about it endlessly this year, the bottom two corners are the ones that are typically the most concerning, right? If you are a stock-oriented investor, as I am, then what we've seen for much of this year is that the US dollar in the lower left and the 10-year Treasury yield in the lower right have been in basically a runaway freight train mode. And this past week has been interesting because we're starting to see a little bit of a difference there. And you can see over here on the dollar that we've now broken down below that rising 30-day moving average. Now, again, I don't know how much we should get excited about that, but at least there's hope, right? In the past, it was just up, up, and away. Now, it kind of feels like over the last month or so, there's been some legitimate selling in the US dollar. Now, this is the US dollar versus a basket of other currencies. So I can't say that's the case with each and every individual currency around the world, but the dollar versus a basket of currencies is now a little bit weaker today than it was just 2 weeks ago. And the last time we were trading below the moving average was back here in August. But of course, that quickly reverted and we were back above the moving average within, a week or so. So we'll see where it takes us, but at least there's some hope here that the dollar can weaken. And if that's the case, then maybe foreign investments could be a slightly more attractive consideration. You might also find that some commodities could do a little bit better in a falling dollar environment. So we'll keep our eye on that, but the dollar was down over 1% today, which is a pretty big move for that behemoth within the currency world. The TNX was also down today. It was a rare day where finally bonds were up. I mean, it's like pulling teeth just to find those types of days these days. It's been incredible to watch the meltdown in the bond market this year. But today we did see interest rates lower and bonds up. We did still close above 4% on the 10-year. We were at 4.10 when it was all said and done, and we still have a lot of inverted yield curves out there as well. In fact, even the 3-month and 10 years were inverted, at least briefly here today. So we still have problems in that area without a doubt. But hey, 2 out of the last 3 days, we've actually seen falling interest rates. And that's probably part of the reason why we've had 3 days in a row to the upside in the stock market, right? All else being equal, we'd like to see interest rates cooling off if we want stock prices to go up. But as you see this chart here with TNX, it still looks like it is well entrenched into a uptrend at this moment in time. That can change, just like the dollar changed eventually. But right now, I think we would be just guessing at this point to say that it's rolling over right now. Right now, it's still entrenched in that uptrend, and we still have a strongly bullish posture. It's still above its rising moving average. Long-term U.S. Treasuries were up nicely today, up nearly 3%, but it's really not saying much considering that they've still lost 19% in the last 3 months of this chart. But hey, at least we'll take a win here after 3 days in a row of oversold cluster signals. Foreign bonds were up today as well, but also remain with a strongly bearish posture below that falling moving average. And then high yield bonds are actually giving us a little bit more bright spot because they're above their moving average here. And as you can see, light green background telling us that we have a weekly bullish posture. So there's a little bit more constructive activity there with high yield bonds. And remember, that's the riskier end of the bond market. And so that's actually a good thing for the risk appetite of the market in general. So we want to keep our eye on that story. Bitcoin was up nicely today, up 4%, and breaking above its moving average. It is now above 20,000 once again. It seems like it's been bouncing between 19,000 and 20,000 here for the better part of the last, call it month and a half or so. But we've largely been below the moving average during that time period. This time feels a little bit different because we're actually hanging out above that moving average. Then again, the Bitcoin has been somewhat correlated with the NASDAQ. With the NASDAQ likely to sell off tomorrow, maybe Bitcoin ends up getting hit a little bit there as well. We had a big day there for the developed foreign stocks, up about 2%, and then the emerging markets still struggling, down 0.83%. I'm sure David probably talked about that with you yesterday, but a lot of those Chinese stocks got absolutely demolished yesterday, Alibaba and others. So emerging markets can't seem to get out of their own way right now. They remain with a strongly bearish posture. In terms of our sector breakdown, let's just briefly review what happened today, which of course was bullishness across the board. Clean sweep of up moves across the board, but we still do have two bearish postures on our hands with the utilities and REITs having that role because of their interest rate sensitivity. But as you can see with the vast majority of the other charts, most other sectors are now trading above their 30-day moving averages, and the financials, energy, and healthcare all have strongly bullish postures at this moment in time as well. So things have improved quite dramatically here in just the last couple of weeks. We'll see what happens after tomorrow's likely sell-off, however. All right, let's get into our trade application example. Some of you saw me tweeting about Brazil over the weekend, and I was talking about how Brazil is an important emerging market, and it was actually breaking out. This is Friday's candle right here, and it broke above some pretty nice resistance areas here. Looked pretty healthy there on Friday. Now the last 2 days it's given that back and now rests just barely above its rising moving average. We know that because that moving average is green. So we're kind of back in the middle of the range now, where we're not quite sure if it's going to want to continue its breakout or whether it's just going to kind of settle in with sideways behavior like we've seen before. So what I ended up doing here with this today, as those of you that have access to our private Telegram channel already know, because remember we do these trades while the market is open, so that way our premium members can be notified of the trades while the market's open for their own consideration, and then we talk about the trades in the free video later on that night. And so what I ended up doing was an iron condor on EWZ. I'm still a little bit hesitant about, calling this a major bullish turnaround in the market in general. So I didn't really want to put on a big bullish trade. Remember, I did that already. I did that with Adobe a week and a half ago when we were oversold, and I was hoping we'd get back to the moving averages, which we did. But now that we've actually gotten there, now I'm starting to wonder, did we go too far too fast, right, in the market? And therefore, I'm not really of the mindset that I want to take a bunch of bullish trades right now. If anything, I might be willing to take bearish trades right now. But in this case, there's probably not a lot of charting evidence that would make you want to take a bullish trade, a bearish trade, unless you were anticipating something. And sometimes that can work as well. So when we're kind of waffling like that, where we're in this no man's land of, we've gone too far bullishly where we don't want to take on an additional bullish trade, yet we don't have the technical evidence to support a bearish trade necessarily, then an iron condor can be kind of a nice, way for us to pass the time. Because remember, it's a neutral trade where it allows us to make money on a security if it just travels sideways. What I did in this case was I sold the December contracts, the monthly contracts on EWZ, which is the Brazil stock ETF here in the United States. And I sold the, on the top side, I sold the 38.39 call spread. And on the bottom side, I sold the 25.24 put spread. And so you can see these two blue lines I've drawn on the chart here represent my break even for that trade, and I was able to get filled at a 30% return on risk, which is what we oftentimes shoot for with these spread trades. So I really liked these, the amount of range I'm giving here. It feels like I'm casting a pretty wide net in this case. Now I do have to be in the trade for 50 days, so there's that aspect of it, and a lot can happen in 50 days. But for right now, you can see that my upside marker up there in the blue and my downside marker in the blue as well fully contain all of this securities trading in the last 3 months. So if all I need it to do is stay within those bands for the next 50 days, then there's a pretty decent chance that I'll have the ability to see that through. Where this would be threatened is if the markets do get seasonally strong here as we head towards the end of the year. This one is easily outperforming the S&P 500, so there's a little bit more of a bullish tilt towards Brazil right now. But after the last 2 days of selling, it kind of made me think, well, this one may be setting up more as a neutral candidate as opposed to an outright bullish candidate. So let's just see how we do with an iron condor here in this case. So again, for those of you that are newer, that is a multi-legged strategy that involves 4 different strike prices where you're the seller to start the trade and you take in a credit to start that trade, and your hope is to hang on to as much of that credit as possible throughout the life of that trade, and ideally have those contracts expire worthless. And if that's the case with this specific trade, I would make 30% on my risk that I'm taking with it. So we'll see how that shakes out, but wanted to kind of concentrate on Brazil here today since I was tweeting about it over the weekend, and it's kind of starting to stand out in terms of its outperformance versus the US markets here all of a sudden. So that's what I had for you here tonight. I hope you enjoyed the video. We had a lot to go through because it was an important day. And if it wasn't for those darn after-hours earnings movers, we would have a lot more bullish vibes going into tomorrow because there was some pretty constructive price activity in the markets today. But unfortunately, the reality of the situation is we will have to deal with a sell-off in all likelihood first thing tomorrow morning, and then we'll have to reevaluate those charts again and see where they take us. So in the meantime, maybe doing some neutral trades like iron condors can get you by. So if you appreciated the effort that I gave you here tonight, I ask one very simple thing for you to do for me. Just take 5 seconds out of your day and click like for me there on Twitter. As long as we're up and over 100 likes by the time I'm scheduled to do the video again on Thursday, I'll plan on giving you another full-length video like this with a trade application example at the end. If we're under 100 likes, then I'll just plan on doing a quick hitter 15-minute video on only the indices themselves. So we'll let you guys decide collectively what you would prefer there. At any rate, I appreciate you tuning in here tonight on this very important market day, and I'll wish you all the best of success with your trades and your investments moving forward. Good night, all. Bye-bye.